Hi, everyone. Welcome to the Seattle Angel Workshop Series. Today we have Andrew Klein talking about financial due diligence. Andrew?
Thanks, John. And actually, I'm really excited to be here today because John and I met about 10 years ago, maybe 11 years ago, when I was working at, another angel investment group. And one of the things that I recognized was that entrepreneurs and investors really struggle to communicate about what was most important, i.e., the returns and how investors got paid back. And so I thought if I could just start Z counting and help entrepreneurs and investors communicate better, then we'll have a bunch more investment in Seattle. Companies will do better. Everyone will be smarter. And really what I found out is that a lot of the reasons why there were not communication around financials were because entrepreneurs just didn't have the basics of bookkeeping and accounting and financial. So that's why today Z Accounting does bookkeeping for over 300 early stage companies, not just startups anymore. We're doing it for a little bit of everyone. But really the foundation of the company was about communicating around financials and really around this financial due diligence. So I'm going to pop up the slideshow now and share my screen. So again, I'm the founder of Z Counting. We work with over 300 entrepreneurs nationwide. So the Dory, who mentioned she was in New York and Greenwich, we're actually working with clients in New York and DC and Chicago and such. I originally started my accounting career at Moss Adams, auditing small publicly traded companies and large private companies. We've also got an in-house CPA, Larry, who's really great. And then just in time, we'll skip through. What I'm going to look through today is what our agenda is for today is we're going to do an intro to financial due diligence, an overview of the key financial statements with sort of explanations of what I'm looking for in terms of due diligence, a deep dive into the income statement, the balance sheet, and cash flow statement, and how those are relevant for your due diligence, assessing the financial model, sort of some ideas of how the entrepreneurs are thinking about the financial model assumptions and how we're supposed to validate those, and also red flags and common pitfalls that we're running into across the board. So financial due diligence is the process of evaluating the financials of a startup. Again, you can read through the slides, but really what we're thinking about for the financial due diligence, especially on early stage, is this reasonable, and is the entrepreneur going to be a good steward of our investment that we're investing in this company? What sort of financial rigor have they done? One of the big red flags that we've helped our clients prevent, but we were seeing a lot when I was working in the angel investment firm, was that we would invest in a company and the first 100,000 we invested would go to past due payroll taxes and IRS penalties, because the founder sort of started their company and didn't really know what to do, didn't ask for help. And by the time that they had enough traction to get investment, we were running into these challenges of outstanding payroll taxes, outstanding IRS bills, non-compliance and such. And so really financial due diligence is to make sure that the business is really operating the way that it should be and being professionalized and being looked at by the founders and respectable. So diving in, this is the P&L, and I'm doing it in the context of a tech startup. So of course, your top line is your revenue, all sales. We're seeing a lot of these coming in from Stripe or from individual invoicing. In terms of cost of goods sold or cost of services provided, I like to describe a McDonald's hamburger because a lot of people, everyone knows what a McDonald's hamburger is. And so when you think about selling a single hamburger out of a McDonald's store, you think about the components: the all beef patty, special cheese sauce, lettuce on a sesame seed bun. And so when you're thinking about a tech company, think about the different products that are directly tomatoes or lettuce that are involved in delivering that that service. And so when you're analyzing the gross profit, it's really important to understand, is the entrepreneur profitable? Is the product that they're delivering profitable? When you're looking at a common example is WeWork. WeWork continued to grow, and they had an unlimited amount of money from SoftBank. But on the core metrics of each of their individual spaces, they were assuming that sometime in the future with volume, they'd become profitable. But each individual location that WeWork was in wasn't necessarily profitable across the board. In terms of the expenses, the three major categories that we're looking into that we think that entrepreneurs need to, or entrepreneurs and investors need to have communications about, is marketing, the engineering and R&D, and the administrative overhead. Different investors look at these different categories in a different way. I think everyone wants your administrative burden to be low and have the investment going into marketing, which is creating more revenue, or R&D, which is creating more assets in terms of software product. And so, you know, a lot of investors will focus on what is that R&D, what is that software asset that we're creating, what sort of future value are we creating through the software engineering. And so they'll be looking for a lot of engineering headcount. This is probably more of a series B or C sort of investment, like how much money can we lose to invest in these headcount resources. I think that John and I would probably be aligned on focusing on marketing and making sure the marketing has a positive ROI and that the entrepreneur has enough gross profit that the marketing pays for itself. The balance sheet is I think a little bit harder to understand for investors and for entrepreneurs. So in terms of the balance sheet, I'm sure that everyone recognizes the different components. So short-term and long-term assets, liabilities like credit cards and accounts payable and loans, and then your equity in terms of common stock and preferred stock. The most important thing I think about the difference between the balance sheet and the profit and loss statement is, and I think about going on a run, and although I sort of like running and I'm doing running, the profit and loss is essentially me going on that run, and it's telling, it's essentially the tracking of where I went and how the run went and all the metrics of which, you know, what my speed was and at the different times. When you get to the balance sheet, it's like I sat down on a bench halfway through my run and I took a look back at sort of where I was at, how tired I was, how, you know, worn my shoes were, how much sweat I was, you know, and so when you're thinking about the balance sheet, it's just a snapshot in time of that very moment of the exact cash balance, the exact outstanding assets or liabilities. And so when you're comparing those two statements, I think that the profit and loss is going to be more telling of how the business operates, whereas the balance sheet is an assessment of a point in time of where that entrepreneur is. You know, also looking at the metrics, there's a lot of metrics that can be that can be sort of pulled from comparing the balance sheet and profit and loss statement. One of the things that we like to do is we like to take a look at the net income or the total expenses, how much money the startup is losing on a monthly basis, and compare that to the cash and the accounts receivable to see how many months of runway that entrepreneur ultimately has and how long the money is going to last that we're investing into the company. Cash flow statement is also a pretty complicated statement. A cash flow statement is really breaking out where is the entrepreneur spending the cash and how does the cash from the balance sheet reconcile back to the profit and loss statement. There's been sort of a change in how we're treating the research and development tax credit and engineering expenses in tech companies today. And so a lot of the engineering expenses are being put directly on the balance sheet. So they're not affecting your profit and loss or the profitability of the business. They're sort of disappearing off of the profit and loss statement. So in a lot of cases, when you subtract the engineering expense, which is a large expense on the profit and loss, and I'll go back over here because I see a couple confused looks. So if you take the engineering expense and reduce that for the software asset that you're creating, these are the algorithms, these are the main base software, you're going to be more profitable at the end of the day than you would have been if you directly expense these. So this is also going to go on to, I'm not sure if you can see my mouse, but about the sixth line down is your software asset. This is going to increase on the balance sheet. So when reflecting that single expense, your cash is going to go down, but your net income is not going to be affected by those engineering expenses that go to the software asset. So this would be pulled out and it would be evident in investing activities on your cash flow statement, because you're investing in creating that software asset or acquiring equipment. Financing activities is where you're going to see the investment coming in and what sort of the timing of the investment is. You'll also see in the equity section preferred stock. If you have a comparative balance sheet, you'll see last month we only had $1 million of investor equity in preferred stock. This month we have $5 million, or in the terms of a convertible note or safe note, you'll see those on there too. But this is all they're going to be the clearest way that you'll see in terms of financing activities, what sort of loans maybe the entrepreneur's getting, if they're running up a credit card, if they have past due liabilities with the IRS, etc. Those financing activities, the debt, the equity, is going to be obvious here. Operating activities is of course, I skipped over that's sort of your daily profit and loss sort of stuff that comes through the business. And then also this is a clear show of your free cash and how much cash you're actually burning on a monthly basis above and beyond just your profit and loss cash. So in terms of building assumptions for the early stage model, one of the things that we really take a deep look into is your revenue forecasting and your sales forecasting. A lot of startups will look at the total addressable market and they'll say, this is $1 billion market, and if we just get 1% per month, we'll be millionaires, right? And we think that although that's a great gating factor, that's really not the best forecasting method for forecasting revenue in a startup. Some of the factors that we like to consider is we like to consider that sales don't just fall out of the air, that if you build it, they will come is only for the movies. It's not really for a real company. And so what we like to think about is the cost of customer acquisition, and compare that with sort of lifetime value of customers and churn rate, and take a look at what is the input that's required to make that one sale. And so, if you can build a funnel in the financial model, you can understand how the entrepreneurs are going to take their sales strategy and move that forward. And so one of the things that we would be looking for in a due diligence is we would be looking for how are the entrepreneurs going to get that 1% or 10% or the total amount of market size that they're expecting to get? Is that going to be a direct sales effort where you have a salary for a direct salesperson that's dropping into your marketing category that then results in a number of contacts, which then results in a number of closed deals? And do the closed deals lifetime value really pay to be able to afford to have that direct salesperson going out and dialing for dollars? And so if you're selling $100,000 contracts to Fortune 500 companies, that usually seems like a model that's profitable and could be used to grow a business. The other one that you're going to see is your Google ad clicks, your Facebook ad clicks, sort of building that funnel from, we're going to spend this much on direct marketing and ad click marketing. That's going to convert in a number of customers that are seeing our product, that converts to a number of customers that close the deal. And so I'd really encourage to take a look at sort of that bottoms up approach in terms of analyzing the revenue forecast for an entrepreneur, and use the top down approach of the SAM and SOM and TAM as really a gating factor more so than anything else. The other thing you want to look out for is a lot of these entrepreneurs are going to show a hockey stick, which I think is important, that the entrepreneurs are thinking large and that they have sort of a plan of, here's the resources, here's the hiring, here's the marketing spend that we need to do 50 or $100 million. And the fact that they've gone through that, I think, is important. But if they start selling more customers than the total customers that exist in the market segments that they're targeting, I would ask more questions around that. The other thing that we're seeing a lot of in due diligence right now is a pretty standard product that is pretty obvious. There's a good flow of how this product is going to sell, whether it be direct sales or that they've validated some of their assumptions on cost per click advertising, and they get to a couple million customers, and then they say, well, by the time we have a couple million customers, we're going to have big data, and that's going to add an extra $10 million a month, right? I think that having a conversation about what is this new big data that we're going to get that's going to be worth $10 million a month, and how are we going to sell that? Because that I'm seeing that popping up on these financial models as just this sort of fluff amount that's that's sort of appearing out of nowhere with no cost structure behind it. Also, I think that there's a question of conservativity in terms of the model. I really like John's sort of method of having validated assumptions, researched assumptions, and sort of off the cuff, I know best sort of assumptions. And so being able to go out and figure out validated assumptions and highlight those in the model as stuff that you know is true, I think is really great. I think about the first company that I started in, and I'm pretty old. You can probably tell from my gray hair. The first company I started was when I was at the UW before water bottles were invented. And this is kind of a joke story, but before water bottles were invented, we had to drink water out of cups. And so we had this idea that if you put a top onto a cup, then people could take their water with them, and it was a more easier way to consume water on the go, right? And so what we did is we went to the UW library and we researched how important water was for people, and we researched that 80% of the body is water, and that you have to have water to be healthy and everything like that. So we knew that people would pay $1 to get water because we did a ton of research on how important water was, right? And that's a totally valid assumption. We could put that into our financial model. We could say water's worth $1 because it's so important for people to have water based on our research at the library. And so that's a sort of researched assumption that proves that water would be important. The other thing that we did to have a more validated assumption on water is we went to the quad underneath all those cherry blossom trees and stuff like that, and we took little plastic cups of water and we got the saran wrap. And this is before press and seal was invented, because press and seal is just awesome. But we took saran wrap and we would fill cups with water and put saran wrap over it. And then we offered these at a table in the middle of the quad, and this is the first time that people had portable water. And we asked what they would be willing to pay for these and if they would make a donation. And so we would track if someone gave us 50 cents, a quarter, $1, $2, $5. And that way we were able to find out that the average person was willing to pay $1 or $2 for this saran wrapped plastic cup of water. And so that's also a validated assumption with real customers paying really real money, which I think would be even more valuable. And I think that John would agree that we've actually sold to real customers and validated our product. And so when you're looking for revenue assumptions, it's totally valid that you have an expert in a particular domain that knows the market and can build a financial model. But I think it's even more valuable if the entrepreneur has gone out with a minimum viable product like my plastic cup with saran wrap over the top of it for a portable water. And you're able to validate how they validated that the customers are really willing to pay for what they do. And then also assumptions can change. And so one of the things that we coach entrepreneurs is when you start talking to investors, the process doesn't happen overnight. You're going to be talking to investors for 3 to 6 months, building a relationship, building your company really, and getting the help from investors and meeting more investors. And so we encourage entrepreneurs to continue to sell, spend at least full time selling while spending full time raising money from investors. And as you're selling, update your assumptions as you get better information and more information on how your business grows and the successes you have. And if you're meeting with an entrepreneur and one month they say, hey, we're targeting, AT&T as a customer, and the next month they come back and say, we closed AT&T as a customer, and now we've got 100,000 in revenue, it's going to be a lot more attractive deal as well. In terms of building expenses for companies, a real important thing to look at is your fixed expenses versus variable expenses. And so understanding, and this is really important, I think, for the investors to look at too, when you're investing in a company, what are the hard costs that are unavoidable on a monthly basis? that we're really supporting and paying for, that support that growth of the business. And so when you think about fixed cost, you're thinking about, the salaried payroll every month. That's a fixed cost that's not necessarily increasing with more sales, but doesn't decrease if you have less cash in the bank, unless you're firing a person. Your rent, your SaaS subscription fees, in a lot of cases, your storage on AWS or Azure. Those fixed costs create a minimum sort of profitability that you need to achieve every month to move forward. And then when looking at the variable costs, these are the costs that fluctuate with the number of customers. And so I use the example of Twilio. Twilio sends text messages, and I think each text message is a penny. But if you had a service where every time that your client logs in, and your client logs in an average of 22 times a day, it sends a text message to two-factor authenticate, your cost of 22 pennies per month is going to be a cost that fluctuates based on the number of customers that you have that are using that Twilio cost of goods sold directly for that account. And so when you're looking at these variable expenses, also don't forget that some variables feel like fixed expenses. A lot of these SaaS services are sold in sort of a number of API calls or blocks or a number of users. And so just make sure you understand that you're able to tease through what are the costs that are going to increase as more sales increase versus what are the base costs. If you have historical data, especially around building of a product or service, that's really, really important because it's really validatable. But if you don't, there's a lot of industry benchmarks that are out there. We see, in restaurants, you can take a look at what Subway does, kind of best of class in terms of cost of goods sold, and make estimations on how close you think that you'll be to a Subway margins in terms of a restaurant. We're also seeing with a lot of marketing firms that we're working with, sort of a gross profit that these marketing firms are having on their fees, and we're helping entrepreneurs navigate into what is the best industry benchmark to be working with. Again, being able to validate those industry benchmarks to your exact company are really important. And then also, there's a lot of cases where we're having one-time expenses that are being ignored because these entrepreneurs are creating a model. Okay, we're going to spend $1,000 a month on legal. We're going to spend $1,000 a month on A, B, or C, and they're forgetting that, hey, for patent costs, there's going to be a huge upfront cost and then a light maintenance afterwards. So make sure that you're looking at what are these one-time expenses. And when you raise funding, every time you raise funding, it's going to cost you, $20,000 to $100,000 to bring in that investment money. So make sure that those one-time expenses are also on there. But you don't have a modeling error where you're paying $50,000 a month for legal because you'd raised money. And again, as the business evolves and the business grows and more people are hired, make sure the entrepreneurs are updating that model and forecasting in those new hires. So red flags. And I'm going to go through these and give a little bit of information around them. So incomplete or inconsistent financial statements. I think that entrepreneurs need to understand their numbers, and they need to be looking at financials and running financials. If we are investing money, we want to see an ROI and a return on this investment in this entrepreneur. And if the entrepreneur is not able to track their accounting and bookkeeping and financials and not able to produce a consistent financial statement, I think that that's a huge red flag and that we need to address. Whether or not the entrepreneur has a responsibility is worthy of the responsibility of our investment funds. The other thing that we see is a lot of investors won't invest in a solo entrepreneur because the solo entrepreneur is a single point of failure across the businesses. We did a due diligence with a client and an extremely large local bookseller. And this client was a single point of failure because they were a sole founder. They were the single point of failure across the board for every single department. And so the concentration and all the internal controls really went through one person. One of the things that we do is all of our bookkeeping teams are genuinely teams. So we have a bookkeeping manager and a bookkeeping associate that are looking at this. And we also think it's really important for the entrepreneur to review their financial statements and look at sort of the work that was done and evaluate that. I know at really early stage it's hard to have the separation of duties that you would have at a larger company like your Microsofts and Boeings, but just having an understanding of what internal controls these entrepreneurs have, and also the controls against cybersecurity attacks and keeping that money safe. I had a client. I actually was an accounting manager at a startup that had raised $10 million back shortly after the 2008 financial crisis, and we did a lot of stuff to protect that $10 million of funding that we got through the Cedars program, and some ways to make sure we FDIC insured the whole thing. And so looking at that separation of duties and internal controls is a really good thing to look out for, and watch out for the red flag of the one founder that has all the control. Also, looking at a high concentration in one single customer is a huge risk. We had another client that sold about $7 million with Costco, and their total sales for the year were about $7.1 million. And Costco brings in a lot of stuff on sort of a one-time sales thing, and then the next year they may not have it. They may bring them back 2 or 3 years later. And so when you're looking at that concentration, it is a real great, amazing thing to sell through Costco or Walmart or Best Buy. But the cost of that sale are extremely expensive in terms of marketing and all of that. But also, if you lose Costco, or if you lose one of those customers, the business goes to zero. So the more smaller customers in a lot of cases is better than one single large customer. Again, when you're looking at assumptions and projections, a lot of entrepreneurs will sort of arm wave into these, oh, we're going to do $100 million a year in 5 years. Just watch out for that as a red flag, and it's great that they're optimistic and they're thinking big, but really make sure that you're validating how they're going to get there. In terms of entrepreneurs that are using debt, be careful. There's a healthy amount of debt for maybe physical good products, to have some short-term debt when manufacturing, and maybe some accounts receivable financing when delivering. But just make sure that they're not sort of taking the investor equity and adding a whole bunch more debt, sort of unknowingly to the investors, that's pushing the investors out of the capital stack. Also, litigation and legal issues, and I'm thinking of this more as IRS issues, where IRS or the state of Washington or the state of California is coming back and chasing down money, and chasing down those payroll taxes and stuff that weren't paid. Payroll does pierce the corporate veil to the founder, and a lot of these founders don't have a lot of money, so I would be sort of reticent about investing in a founder that's behind on those sort of liabilities. Lacking an exit strategy, oh, we're just going to build a really big company and then we'll IPO or we'll get sold, isn't enough of an exit strategy. And selling a company isn't sort of you'd be super duper lucky for someone to just come in and say, hey, I want to buy your business, without having run a process and without having targeted these investors sort of from day one. I see a lot of success with people spinning out of Microsoft, creating a product that Microsoft didn't have a budget to create, and then being able to bring that product right back into Microsoft on sort of these sort of loops of build a company, get a nice bonus, get a nice paycheck, build a company, get a nice paycheck. Also, I like to look for the entrepreneur's skin in the game. Some of these entrepreneurs are young and don't have a lot of assets. And so if they're essentially living really modestly, and they're not taking a salary for a number of years, or if they did work at somewhere like Amazon where the stock just went crazy and they're able to take a couple $100K and put that money in first, that gives you a lot of confidence that the entrepreneur's not going to give up, because they've also got skin in the game. I also recommend that entrepreneurs don't just cash out their investment once the investors come in. I would recommend that they sort of keep their skin in the game along the way, because they'll get they'll be able to use that as a deduction when they get their returns. And again, there's a lot of founders, especially here in Seattle, that just are in love with their products and have that if you build it, they will come mentality. I say watch out for that too. So, in summary, we've talked about sort of an introduction to financial due diligence and the reasons why I think it's important. We've talked about the key financial statements. We've done a deep dive on the intricacies and the stuff that I'm looking for on income statements, balance sheet, and cash flow statement. We've talked a lot about financial modeling, particularly around the revenue side. And I've also talked about some red flags and common pitfalls. We've got about 15-20 minutes left. I'd love to answer questions if anyone has it. Feel free to just jump on or put them in the chat and I can talk through. Also, John, if you want to hop on and talk about some of the stuff that you're looking for in financial due diligence, I'd love to have your input as well.
Yeah, great. Thanks. Can you lower the screen and we'll get everybody on the screen? Yeah. Just
Perfect.
take your spotlight off. So, let's see. Get to gallery view. Everybody should be able to see everyone. Does anyone have any questions they want to put up? No, not
Yeah, so
hearing
it looks
it.
like Ashwin had a question about the burn rate. Is it all the monthly expenses, including COGS and expenses? So the burn rate is in a lot of cases just a back of the envelope. How much money are we losing on the P&L? And if the entrepreneur is on a cash basis, that is probably enough burn rate, taking a 3-month rolling average. But the things you also have to look out for is you need to look out for how much of software asset are they building on a monthly basis. And so having a comparative balance sheet to see if they adding $20,000 a month to their software asset, that needs to really be included in that burn rate. And also if they're selling product and the product is profitable, you're gonna also add in what's the sort of credit that we're getting from that gross margin, which would take into account the cost of goods sold. And so the total expenses is not enough really to find the burn rate. It's the total expenses less your contribution from your sales plus your plus or minus. I'm not sure which way I'm adding right now, but adding back in those expenses that are going straight to the balance sheet for engineering.
Well, we need to be careful because the investors are looking at it from a short-term survivability question, and we're looking at whether or not they run out of money and have to close the business. And so we're really thinking about it from a cash basis at that point. And a lot of times startups will have trouble managing an accrual accounting system and managing a cash basis of their understanding of where they're at with their accounts, right? They can easily set up their accounting in a way that they're not seeing the fact that they've already spent the money that's in their bank account.
Yeah, I think accrual versus cash is a real big challenge for all business owners. The difference that we're really looking at is accrual is really capturing when was the sale earned and when were the liabilities due. And the cash that follows those, when you sell to a bank, you might get 90-day payment terms. Philips, we have a client that sold to the Philips Hughes sort of smart lighting group, and they were 75 days from the last day of the month that you submitted the invoice. And so in that case, in some cases, it was over 90 days that we would get paid from that customer. But the entrepreneur saw the revenue and stuff come in day one of that 90-day period, even though the cash wouldn't come for another 90 days. And so looking at stuff on a cash flow basis and a cash based financials, and QuickBooks allows you to flip back and forth between those accruals and cash. And so really cash flow is what we need to be looking at, especially at early stage.
So Dory asks whether there's courses or online resources that would be really good for a startup to understand.
Well, I'd say follow John's series of courses here at the Seattle Angel Conference. No, it's tough because even in school when you're studying accounting, they're teaching you about the nitty-gritty debits and credits, the rules of whether or not cash is an increase of a debit or an increase of a credit, and from which perspective, from the bank's perspective or from the company perspective. And so you're really not understanding the stuff that you need to do. I always joke during parallelogram season, I'm sure happy that I learned about parallelograms in high school, right? And so I think that getting connected with programs like Seattle Angel Conference and whatever the equivalent sort of networking events and the law firm seminars is going to be a really great way. Also, the process of going through Seattle Angel Conference, I think, is phenomenal. I keep encouraging John, you should do this in every city, because giving investors an opportunity to learn about how do we make this investment with some people who have made investments, with some people who are also figuring it out. I think that you're teaching the people like Gary Rittner, who's been doing investing for over 200 years. You're teaching guys like him sort of new ideas of how we're going to do due diligence, and then you're getting the advice from guys like Gary of here's how we've always done it, and here's the stuff that we're looking for, and here's the pitfalls that we've seen, over reviewing 6 million companies that Gary's probably reviewed.
Yeah, absolutely. So just to put that in perspective, Gary is the one that started the first angel conference or angel group in Seattle. So he's definitely seen a lot of things. I think one of the things that's really useful from an engineer point of view when you are like, I'm at Microsoft or I'm at a company and I'm learning and I'm going to go do this startup thing, is to do a little version, right? Do a little project of something, right? Start that food cart version of the restaurant, not start the $5 million version of the restaurant, and try and get the basics to happen. And one of the ways to do that is to just simply look at your lean startup methodology, right? I at the very beginning need to have customer problem fit. I need to know a bunch of people that have the same problem, and I need to find in that group of people the collection of people that are the early adopters that will spend money now. And you can build a content strategy that you monetize, and that content strategy that you monetize that's simply going and talking about the problem and finding people that have the problem and talking about how that problem is solved today, which you then charge something like charge for Zoom meetings or whatever to monetize that process, then gives you a cash flow you have to manage where you have to set up all of the basics of it anyway. And so that ongoing process gives you a little tiny baby business, which if you do that across the 15 possible sub markets that you could do, you end up with a bunch of baby content companies, which there are plenty of internet influencers who do that. That's all is content, and that's what they do. You just created 15 of them, of which 13 of them you should stop paying attention to at some point as you pick the one you're going to focus on for the product you're going to build. And as you do that, you sell those businesses off to other people on a site like acquired.com and focus in on the submarket you care about. And all of that work that you did with just content strategy and just customer discovery of customer problem fit then teaches you all of that accounting stuff.
Yeah, that's a great point. My first business was a chain of crepe restaurants back in the day, and we used to do crepe parties when I was in college. I'd make the crepe batter. People would bring over different types of recipes and ingredients, and so I was able to essentially, people would throw in $20. Oh, hey, thanks for hosting and whatever, and I was able to buy my first sort of crepe equipment through doing these little parties, which led into my first catering, which then ultimately led into 3 locations and $1 million a year of sales at 22 years old, until 2008 crisis happened and they only bailed out the banks, not the small businesses. So, so now we're here doing accounting. So I always encourage people, think about your crepe party for your software company. What is the crepe party? Who are the people who would care the most about this? And how do you really get users that are excited about what you're doing? As much as people are excited about my Nutella crepes and our Indian curry crepes and all the other fun stuff that we experiment.
Any other thoughts or questions that people have? I see that Evan is putting a suggestion. Evan, you want to talk about that?
Yeah, yeah. I had an interview with this guy that had put together this Gen AI company around doing lean canvas work. And what's really cool about it is that use Gen AI, you can put in just an initial, like, I would like to start a business dog walking, and it'll create and fill in all of the lean canvas categories. And then it'll also put together like interview questions for you to go out to do customer discovery with. And then the cool thing is when you go through and do your customer discovery, you can do something like you take a Zoom call, it'll transcribe the Zoom call, and then you just go through and highlight sections of the Zoom call for insights. And then you can auto associate those with areas of the lean canvas. and say this is a validation or this is a denial of this assumption, and then you can quantitate, what do you say, translate the qualitative analyses to the quantitative and validate your customer discovery that way. And it keeps track of it all with nice analytics and stuff. So it's rapid.
I haven't looked at it before, but I hope that they model the fact that as I look at my product, I might have 15 different customer sub segments, which means I have to do 15 different lean canvases with 15 different problems, with everything gets exponential in that.
Yeah,
I
they
see.
have that as a component.
Cool, thanks. Thomas has a question about whether non-GAAP compliance reporting matters to VCs.
I mean, eventually, I think that GAAP matters. I think at an early stage, GAAP requires a lot of these internal controls that we glossed over. GAAP also requires accrual accounting. And so I think that there's some arguments for cash-based accounting early on for entrepreneurs that are really tracking how much life they have left in their cash bucket. And that but by following GAAP and with the accruals, they may have a disconnect to the actual money that they have. Also, GAAP is really focused in Sarbanes-Oxley on these internal controls and on preventing fraud and on all of these things. And it would create an unnecessary barrier for that entrepreneur to be able to even pay bills and access bank account and access their ability to build their business. And so I would say in super early stage, GAP's not as important, just understanding the financials. And we actually had this argument with the large bookseller that was doing due diligence, and we said, hey, you've got their bank statements for the last 5 years. There's no more than 100 transactions on each bank statement. Why are we fighting over a GAAP? GAAP variances in this case when there's only 5 W-2s in the whole company. We're not going to have our marketing person approve the CEO's ability to pay the legal bill. And so yeah, someday once the company's big enough, let's look at GAAP compliance. But in the short term, I'd say it's not absolutely necessary.
So it would be fair to say that most of the MBA equations that value a company don't really start working until you're sort of past Series A, maybe beginning to work in Series A. So everything before Series A has significant amounts of hand waving in the understanding of the business. And so when you've got lots of hand waving, then financial compliance with GAAP makes a lot less sense. You see Ashwin asking, what's the typical structure for startups that approach SAC for an investment?
I would never invest in a company that was not a C Corp. S Corps are going to create a whole bunch of problems that if there's any distributions, it has to be distributed equally across all investors. And then in an LLC, it's going to affect your taxable basis. Whether or not it's a passive investment or active investment in the LLC, it's going to affect what your tax bracket is and liability, because all profits pass through in both the S Corp and the LLC. Whereas the C Corp is its own little thing. You get your capital gains when the company sells. If the company's profitable or not profitable, the company itself pays the tax. And so that's probably the safest and most effective way to invest in a company. So if there's a company that was coming in that was not a C Corp, there would be a ton of questions. And Delaware C Corp is going to be the most popular because Delaware was the first state to have corporations. I don't have an opposition against a Washington C Corp. I think Microsoft's now Delaware, but they were originally a Washington C Corp when they were first starting out. You're going to have to re-register in Washington anyway. So our sort of advice is if you're based in a state like Washington or Texas or Nevada, where the corporate structure isn't totally negative against corporations, creating a C Corp in the state that you're already operating is not a poor choice. And then to have the least amount of questions, a Delaware C Corp is going to be your plug and chug. It does get sort of expensive because there's a minimum of $450 for the Delaware franchise tax. There's a minimum of $800 for the California franchise tax. So just watch out for those additional tax locations. Does SAC have a process to help restructure? I think that SAC would be happy to introduce the entrepreneurs to Car Tuttle Campbell. And Adam, I hope they're still your sponsor, John.
They are.
But most of these law firms, especially like Cartel, I think Cartel is really reasonable because they're sort of a mid-sized law firm. They can help do that. Sort of maybe a fixed price. On the East Coast, I've got some other referrals over there that I'm not going to mention because of Cartel's thing. But if for Dory and I think someone else mentioned they were on the East Coast, we've got some fixed price legal solutions over there as well from sort of medium-sized firms to help do that quick conversion and help those entrepreneurs be in the right structure for investors.
It's not really expensive. It's $1,000 or so to do the conversion. It takes a couple of weeks. Not really a big deal. But in general, we don't want any surprises from the investor point of view. And you making money but not giving us money to pay our taxes is a surprise. And so we definitely want the C Corp. And so we won't make the investment without C Corp. And we have waited until the company has converted before we fund the company.
Yeah, I don't know where John's getting it for 1,000 because I'm seeing it more like 5,000, but somewhere between 1,000 and 5,000, we'll see the conversion. So
Yeah. Any other thoughts or questions from folks? Okay, so tonight we're running it at this time because we provide some opportunity for our European people to come in when we do it at this time. But tonight in Seattle, we're going to do a Meet the Funders event, again, virtual. And so we'll have a collection of the different angel groups that are active in the early pre-seed stage talking. And so that'll be a chance for you to have a little breakout room with someone like Gary from Alliance of Angels, or someone from Kretsu, or someone from a couple of the micro VCs, and try to understand how they're sort of different from each other and where they pay attention. Are we going to share the slide deck?
sure. Yeah, you should already have a copy of it if you want to
Yep.
add it to add a direct link. I think it's publicly shared right now on
Yeah, I'll send out a note on Meetup to everyone, so you'll get a copy to the slide deck.
Perfect.
Thanks everyone for coming. We
Thank you.
appreciate it. Hopefully we'll see you tonight. Do pay attention to the meetup group. And if you have someone who's interested in coming in as a company, apply early so that we can connect you up with some investors to sort of polish your Gus profile. It really helps if you spend a little bit of time getting feedback. And then if you're an investor and you want to learn more, feel free to drop me a note. Thanks very much.